Talk to me a little bit about what's most distorted in the markets right now.
The bond markets continue to be most distorted. It's extraordinary to see. We just talked about UK inflation heading up. It's pretty much upward pressure on inflation rates all over the world, and the bond markets are still not responding and therefore appear very, very stretched.
Okay, we're looking at record highs on the S&P 500. Part of the narrative may be that markets are functioning differently because you have algorithms that are not able to actually price, for example, nuclear threats, right, coming from tweets from the president or from North Korea. Is that true?
Well, I'm not sure that anybody can price nuclear threats, to be honest.
Fair.
I wouldn't know how to start, even, and I'm not an algorithm, but I don't think it's to do with algos or ETFs or anything like that. It's what we've been talking about now for 10 years, I guess, which is quantitative easing and the politics of financial repression, which we're seeing work particularly well in the UK. With real wage growth under pressure and obviously negative real interest rates. And the consequence of that is that there's still no other way to go than take risk, and equities will benefit from that.
Within the equity benefit, Andreas, is the idea of higher inflation as we see in the UK, and the idea of greater revenue growth is a general statement across any nation, across any GDP. Is Allianz modeling in better revenue growth?
Yes, we are, and we're seeing it. We started seeing it in China, the Q3 2016. Since then, earnings have improved. We expect a reasonably good earnings season in the US, and we've also seen good surprises in Europe. So overall, inflation and higher earnings growth are often correlated. Now, there is a limit to which equity markets like inflation, and that typically is in around the 4.5% range. We're not nearly there. So in the initial phases, a pickup in inflation will be seen as positive by equity markets, in particular, if the yield curve stays low.